James Gautrey is a technology and telecom sector specialist with Schroder Investment Management, joins me in the studio now. But really, the big challenge for HP, James, you're saying it's about restoring investor trust.
Yeah, I think that's right. I think what we've seen over the last few years, under the Herd era, we saw a lot of cost-cutting come out of HP. It was a well-loved stock. And then just over a year ago, when Hewlett-Packard Co came in, we started seeing a lot of changes and the communication really suffered at HP. And the problem has been that investors just don't trust them at the moment. There's a lot of flip-flopping on strategy, sell the PC business, buy autonomy. Investors thought they should have done a buyback. And so really they created a lot of confusion. I think Meg Whitman highlighted that in the call yesterday of saying investors are confused to what HP actually is at the moment.
And that also involves setting reasonable targets, realistic targets, right?
Absolutely, yeah. I mean, I think, as you said, the estimates for the full year have come in underneath where a lot of published numbers were for analysts. But sometimes what published numbers are and what the market are actually looking for is very different. And I think a lot of people were just looking for a full reset to basically get a number that they can believe in, that HP can beat, and we can start to restore that confidence that's been missing.
And interestingly, in your worst case scenario, you've got HP trading on around, what, 6 times price to earnings?
Yeah.
So there's still a huge amount of value to be unlocked there?
Exactly. I mean, it's a very cash-generative business. Meg talked about the net debt is up to about 22 billion at the moment, and they want to pay that back. But, HP can generate probably 10, maybe 12 billion dollars of free cash flow every year. And on a $54 billion market cap, it doesn't take long to pay the debt back. And suddenly, we're looking at 15, 20% cash flow yields. It's a lot of value, yeah.
But I guess that's part of the other big problem right now is they've got to reinvest in the business at a time when you're seeing increasing competition in the IT market. Things are just getting tougher for these guys.
Absolutely. I think it's become very clear over the last year or so that HP took too much cost out of its business, particularly the services section. We saw the margins drop about 4 points year on year from 16 kind of down to 12 in this last quarter. That's where they really need to put the focus in if they're going to return the business back to a firm footing. So reinvestment is a challenge amidst macro uncertainty.
James, do you see evidence that they're doing that?
Possibly not. I mean, you see it in terms that the margin is actually falling. So there's clearly, there are costs going in. If we give them the benefit of the doubt, that tells us we're reinvesting. If we're being cynical, we say, well, maybe they're facing problems. I don't think so. It's a fairly straightforward kind of business that, shares generally stay fairly steady. So I think we can see evidence, yeah.
And not just headwinds coming at them from the market that they're functioning in, but also in terms of the IT market and the competition there. The macro situation, you've got slower growth in both Europe and the US, and that's going to weigh on results next year, according to Meg Whitman. Yeah,
I think that's right. I mean, there's no getting away from that, but we have to remember, of course, that's not going to be specific just to HP.
No.
Everyone's going to be in the same boat. Possibly they face some more structural headwinds than others. We've seen the PC business has been quite challenged by tablets over the last few years. So there's no getting away from the macro. I think they've highlighted that, pretty clearly.
Thanks very much indeed, James Gautrey, tech and telecom sector specialist, Schroder Investment Management. Good to get your thoughts.